Your wealth deserves stability, expertise, security. Your wealth deserves LGT Crestone, private wealth with over a century of global heritage.
Welcome back on this Wednesday morning. Wonderful to be here with you. I'm Nadine Blaney. Well, let's get a bit on the overnight session. I messaged that Microsoft and Google really dominated in terms of U.S. earnings. But yeah, the Dow, for one, has been on a tear, up 12 sessions in a row. For more color, we spoke with Howard Silverblatt from S&P Global in New York.
We've got about 37% of the earnings in at this point in time, and they are running positive. Guidance is not bad. It's about a 77% beat, which is very high. Usually it's 2/3. Tonight, of course, we had Microsoft and Alphabet, which were big items on there, and they came in. Obviously, AI was a major item, as well as the advertising on there, and we had some management changes in Alphabet with the CFO on there. The earnings have come in very well. I should state, though, they're not good, but they're nowhere near the concerns we had before. They're not a decline, they're not a recession. So the numbers are holding up very nicely. And because of that, we're having less talk of a recession and more of a potential flat market going in here. So the earnings component for this right now is good, and it's broad, and we're seeing the upswing on here.
Howard, any other particular results that caught your eye? We had the likes of General Electric. Its shares surged after raising its annual profit. General Motors falling after really a decline there in margins in particular. Also the likes of 3M. What are your observations there?
The margins definitely are an issue at this point in time. They're expected to get worse, but they are still high. We're running about 11.4 for this quarter. The estimate is about 11.2%. Historically, it's only about 8.4%. So margins are high, expected to come down because we're seeing labor costs continue to go up. It's the main inflationary item now. That's what most companies are worried about. We had several strikes and labor situations going on here. So we think by fourth quarter, it's going to cut that down at this point in time. Some companies are warning about that. So the inability to get labor, because we have a labor shortage, the low unemployment rate, has added to the upward pressure on wages, which are now starting to pull down margins to some degree at this point.
Howard, I note it looks as though the materials sector was the best performing one on the S&P 500. I guess a lot of that is based on what we're seeing out of China at the moment, given the rise in metals prices and speculation that stimulus is going to increase demand.
Yes, a lot of anticipation there that China may turn the corner on there. On the commodity side, of course, we also have oil, but that's totally different, which is near the $80 mark. But yeah, there's an expectation that a growing U.S. economy, again, it's somewhat stagnant, but it is not declining, and we're seeing some growth. And then when you add in China coming in, if they could turn the corner, especially on manufacturing, they may add higher demand. I'll note that gold has not gone up that much on here at this point in time. They're still well under the 2,000 mark, and usually that is one of the materials we look for in China. But I'll also say that the luxury market, it seems that China's come back. We had some retail reports today, and a big part of it was from China. So they are traveling and spending. So that's an indicator that we may get more demand from.
Howard, taking a look at the index level there, S&P 500 up close to 19% year to date. The Dow, not as impressive there, but it has been playing catch up. What are we up to? 12 days in a row of increases there.
Yeah. The 19% S&P compared to about seven, with over 7% on the Dow year to date is pretty bad. But again, similar to the entire market, we're seeing the catch up go there. The Dow has actually gone up 12 days in a row with over 5%. Tomorrow we go for 13. The last time 13 happened was 1987. When we opened the year with 13 Dow increases in a row. Of course, 87 was also the year crash when the Dow went down 22% in one day, October 19th. But we are seeing the pickup in the Dow. We're also seeing the pickup across the board. Breadth is a lot stronger since June and July. It's not as top heavy anymore. Of course, the Dow is price weighted. So we're seeing more companies add to the returns. But yes, the Dow's on a little run, but it's a catch-up run, and it still has to do a lot to catch up to the S&P at this point in time.
Could, though, be derailed by the Fed's decision? Look, expectations out, of course, that it is going to lift interest rates by 25 basis points. What do you think the market reaction is likely to be? Of course, it's going to be focused on the accompanying commentary.
But at 2 o'clock our time, we get the results, and about 98% on the futures are saying that it's going to be a quarter of a point. So any variation there would see the markets react however they go. A few are really expecting a pause. If you look at 2:30, though, that's when Powell will have his conversation and his conference call. That's when the market's really going to react. Are they going to pause next time? The market's geared in for another increase, maybe in the fourth quarter. And then if you go forward 1 year into July, that the rates would actually be less than they are now. So again, it's going to be the commentary and his decision. The expectation is that they'll give indications of a pause and that they will wait and see, and that we may get a fourth quarter increase, and then sometime in the first quarter of next year, a decline. Again, market's pretty certain on that. So any variation, any even indication, you'll see the market react quickly. And those option players have already taken positions, because with 98% figuring a 0.25% increase, how can you not play a little the other way?
So that was Howard Silverblatt giving us his assessment of where U.S. markets sit right now, and we'll bring you plenty of analysis of those tech results throughout the session today. But let's really put the view onto China. Investors piled into Chinese property developers' shares and bonds yesterday, following a sharp sell-off in the previous sessions after Chinese policymakers said they would step up support for the sector. The broad rally, though, is fueled by China's top leaders pledging to ramp up policy support for the economy as it, still really struggles with the post-COVID recovery, with a focus on boosting domestic demand. Well, to make sense of a lot of that and where to from here, Dr. Joseph Lai from Ox Capital Management joins me now. Joseph, lovely to have you in today, and just so topical.
Yes.
Do you think that the enthusiasm that some sectors of the market demonstrated about the news coming from China is justified?
Yeah, look, in the context of the extremely cheap or attractive valuation in the equity market in China, a big bounce, I thought was rightly, justifiable.
Okay.
I think the one thing we've got to remember is really the context. So, China has basically a self-induced deflation of the property bubble. It's in the last 2 years. All we hear about from China is property prices going down and demand falling, and in fact sales volume for new properties have come down about 40% from the peak. So that's a big adjustment. But as a result, the economy is actually quite de-risked. Mm-hmm. They're not dealing with a expensive property market, or inflated property volumes anymore. So. I guess if we take a step back, what we're looking at in terms of demand, economic growth out of China, which we all know, is a little bit sluggish compared to what people expected post-COVID.
Just a second, just to interrupt, because I think the word torturous has been used. Now, again, sometimes you think, was that actually said by officials, or is that something that's just become sort of viral?
Yeah.
So you're saying a bit weak, whereas there is this perception that it's been torturous.
Yeah, well, compared to what the economy used to grow by. It used to grow in nominal terms, in some, in the last 10 years or 20 years, sometimes in excess of 10%. Now we're not going to have that. Last 20 years, the growth was driven by more or less a cookie cutter mode of growth. Build more infrastructure, build more properties, urbanisation, the economy picks up, and then technology improvement, all these things.
Yeah.
Product. But now it's not as simple as that. Now it's like, well, the property game is more or less saturated. They'll still build a lot of properties, but it's just the growth of the volume is never going to be the same. So the growth in the future, or today actually, is going to have to be driven almost entirely by just productivity improvement in technologies.
Right.
So it will be a slower rate of growth going forward. But if we look at the GDP per capita in China, which is 13,000 US on average, it's still low.
Yeah.
For it to grow another 50, 100% in the next 10 years, I mean, it is actually more likely than not, but it's not going to be the breakneck rate of growth that we've used to in the last 20 years.
But you're also then saying that there will be other industries that will take leadership in terms of growth.
Yeah, sure. So the picture that we're looking at is, it won't be driven predominantly by construction. Mm-hmm. But other areas in the economy are evidently growing. I mean, because when in our recent trips to China, if you go to these industrial areas, we can see that technologically, a lot of these companies are climbing the technology ladder very quickly, to the extent that there's a lot of local companies. These are private sector companies, right? Mm-hmm. Learning, investing billions in R&D and catching up in terms of the capability in manufacturing and technology. Some examples. For example, I mean, people may not realize this, but China has become the world's biggest car exporter. Mm-hmm. I mean, overtaking Japan, this year, and that's been growing at double digits, particularly in the electric vehicles category. So that's one area, but apart from that, there's I can see areas like robotics, areas like AI and stuff like that. They are just climbing the ladder quickly, and so therefore, the idea of a productivity improvement come out of there in the next 5-10 years, or continuing to do so, is likely to continue. And so this is on the background of a property sector which has been deflated.
Yeah. Okay. What gives, I mean, if you think about geopolitics, because that's always a risk when it comes to investing in China, what gives with Kissinger, Blinken, everybody visiting China? Yeah,
they haven't been to, I mean, American officials have not been to China for a long time, I guess since before COVID, right?
Yeah.
And suddenly last month there's a succession of Mr. Blinken, Ms. Yellen and Kissinger, Kerry as well. And apparently, there's meetings between Biden and Xi in the APEC meeting by end of the year. So that's supposedly what's on the cards. So there seems to be a bit of a stabilization of activities between the two superpowers, which I welcome. I mean, my goodness. And
I think we all should.
Yeah.
But what phase does it sort of take the relationship into? Because there is still onshoring, there is still a lot of nationalism.
There is.
Yeah.
So they use this word now. I mean, at least in the US and to some extent Europe. This idea of de-risking versus decoupling.
Okay.
So I guess it's a fine meaning, it's quite a fine line. But what it is about, China is a huge economy. It's basically not possible to decouple it. In fact, maybe it's disadvantageous to decouple. So, okay, let's decide what matters from a national security perspective, and try to do something there in order to avoid the risks. But at the same time, I mean, economically, it is, let's face the reality of, this is a huge economy that is hard to avoid. So I think that's what is happening, and that seems to be a bit of a softening of tone, I guess, from the US side to go, this is what it is. And secondly, I guess from domestic, some of these things can perhaps be driven by domestic politics. How much political gain is there to be so aggressive anyway at this point? So a lot has been done.
Okay.
between the.
Look, long may it continue. So, are you? How do you categorize your sentiment toward investing in China? You know, are you
Yeah.
bullish? Are you cautiously optimistic? Where do you look for the opportunity?
Yeah, so I mean, I'm cautiously optimistic, and in fact, perhaps should get a bit more bullish. And the reason is just simply that, okay, if we look at this economy, which will continue to grow at, probably, 4 to 5% in real terms going forward, it's going through this huge cyclical adjustment as a result of the property market, deflation or adjustment. The risks has been removed, but it is going to grow slower. So in that situation, the economy is still growing, but there are still companies which will continue to do well and in fact become bigger businesses in the next 3 to 5 years. Much like a strong technology company in the West or in Japan or something like that. Yeah, these economies are not growing at 5% or not growing hugely fast, but I mean these businesses can actually take market share, can actually are actually improving technologically and productivity, and so they will be bigger businesses in the next 3 to 5 years. And the valuation of a lot of these companies are extremely attractive for reasons we all know. Worry about the economy, the geopolitics. But this is a time that the property market has been de-risked, and geopolitics arguably is sort of stabilizing, and the valuation is still very attractive. And so that explains the rally yesterday. The moment that the people, the authorities in China, the government decides that actually. Properties, we have to relax a little bit more, and then to encourage the private sector to actually invest and the consumers to actually start spending. Then the market goes, the valuation is so cheap. It's hard to know exactly, how successful all these measures will be. But, in terms of risk reward, it's actually quite attractive. We talk about companies, some of these companies with, balance sheet full of cash, and in 2 years' time, literally 3 to 5 times PE. So, so we're going through that quite carefully, choosing the winners, because they will still be around in 3 to 5 years' time and bigger.
Well, the conversation came full circle. Wonderful, really timely as well.
Yeah.
Dr. Joseph Lai, thank you so much for coming in. Appreciate it.
Thanks very much.
Joining us from Ox Capital Management. Very quick check on where we're expecting this local market to open in just a few minutes, up by about 0.25%. So we'll be keeping a very close eye on that. Stay with us. We'll bring you through the open next.